All right, welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, you're interested in multifamily investing, or maybe you're already in the industry, you're an industry insider. Well, you are in the right place because on the Gray Report every week we break down kind of everything that's going on in the multifamily industry, real estate, and the economy, kind of in that order, kind of getting to the macro and the micro. As again, where I think we're living in some of the most absolute, insane, fascinating economic times, certainly in my life. Speaking to folks that are much older than I am, they agree. And just seeing what's going on every week is really exciting. So, without further ado, let's just get into the report. All right. Once again, we've got communications and marketing director here at Gray Capital, Matt Bosnagel. Matt, what's going on? How are you doing? Yeah, what's new?
Doing great. Nothing too new. It's strangely warm this morning.
It's
Um,
kind of
but uh,
nice.
but
Well,
that's it for my weather small talk.
so yeah, so you say nothing's new, but we do have some big news. This is the
True.
last show, last episode of the Gray Report where you're going to see Matt's awesome background of the War Memorial, which is not a like green screen background. That's just kind of what our office looks out at now. We're moving to new offices. We're based in Indianapolis. We've got new offices in Indianapolis that we're going to be moving into tomorrow and Friday. So you're going to see kind of a different setup. We've got new changes coming to the show. We have a whole new studio that is being built out. I don't think it's going to be ready to go for next week. So we're going to make something work. But some just cool changes at Great Capital as just, as well as the show in general. So that's always so just FYI. If next week you're like, this looks like a different place.
If
So,
you
Matt,
tune in for
yeah,
just the background, then I apologize.
yeah, yeah. Hopefully not. But I do like your background, Matt. Okay, so let's just like pop right into this Newmark report. Because it's for the third quarter 2021 United States multifamily capital markets report. Um, like I was just telling Matt, we could spend, an entire hour breaking down what's in this report. And I'd like to start just with their key takeaways, and then we can get into some of the details and specific charts and graphs that they feature. Because these are pretty important takeaways, and a lot of it's not going to be essentially new for a lot of people who've been paying attention or especially watching the report, getting the Great Report newsletter. But still, let's talk about it. Sales volume, Matt, in the third quarter of this year, totaled $78.7 billion. It's the largest quarterly sales volume on record as investor appetite for multifamily continues to surge. And I was at an industry outlook presentation and dinner last night. Posted by the Indiana Apartment Association, just looking at kind of Indianapolis sales volumes. We're seeing similar sales volumes. We've eclipsed the all-time record of volumes just by Q3. And I heard that a third of all closings this year are going to take place in December. And so we've got an entire third of volume that is going to be closing before the end of the year. There are so many must close by the end of the year terms included in
Hmm.
contracts. So many owners who are getting older and retiring, and or have the idea they're going to be retiring, and they want to lock in the capital gains rate of this year of 2021 as opposed to seeing what's going to happen next year. And so that was a big push to get a lot of these sales done before the end of the year. So a lot of sales volume, a lot of price discovery. Finally, for last year where we didn't have a whole lot of price discovery. Rent growth, again, effective rent growth rose 5.9%. Again, so it's different from market rate growth. Effective rent growth is actually what people are paying at properties from new and old leases. And again, that's the largest quarterly increase on record. And so that's really incredible. Dry powder. So this is getting into where maybe cap rates are going to go. Are we going to see? Is there still interest in people buying apartments? I mean, we know that there are, Matt, but there's a
Yeah.
record $237 billion. And then this is mostly just like closed end funds. have earmarked $78 billion specifically for residential development. 75% of that is set aside for opportunistic and value add strategies. That's a lot of cash sitting on the sideline looking for opportunities.
Yeah.
A lot of money. So there's a lot of inventory out there, but there's still more capital chasing the opportunities that are out there. Supply and demand. A record 268,000 units were absorbed in the third quarter. I mean, we've seen that number for yearly absorption in the past, Matt. More workers return to the office, and the cost to own single family homes continues to rise to historic levels. Rental housing is anticipated to see strong demand. We're going to get
Yep.
into some of those single family home, that some of that detail as well. Total returns, they're up. In debt markets, the mortgage debt outstanding rose to $1.74 trillion. Not surprising, as values are increasing. So we're going to have those the outstanding debt increase as well. So Matt, a lot of positive signs for the multifamily industry. Um,
Yeah.
and so maybe let's just like get into again some more granularity.
Yeah. What I
Unless
liked
you have
about
so many comments. Yeah.
Oh no, what I liked about this, and this is from last week. It was in last week's newsletter, and I brought it to this week's video because it offers, unlike some of the other ones, it really gets into kind of the investor perspective, and it's talking about sales volumes and cap rates that with just a little bit more level of detail than some other reports. And I thought that yeah, it's a very useful perspective, especially if you're looking at what's going to happen maybe throughout the end of the year.
I agree. And throughout the end of the year, and then the way I see it is it's just queuing up
Yeah.
2022. There's that much capital on the sidelines. A lot of deals are going to be coming to market, and it's not slowing down, and prices aren't going down anytime soon. There's nothing pointing to that, although it could be something out there we don't know about. So again, just look at this, Matt. Just for the three quarters, I've already so far surpassed 2020 sales and are essentially on par with 2018 and have surpassed all previous sale years of sales volume. Now, it's not surprising because prices are up anywhere between 20 and 40%. So you would assume that the amount of the total dollar value of those transactions are going to increase as well. But again, like I said, just the anecdote on the Indianapolis market, a third of all this yearly transactions is going to take place in December. So
Yeah.
this graph it's gonna be blown out of the water, to say the least. And you can kind of see that picking up here as sales volumes. We had a lot of deals closed in December, because people had put off deals, things were being held off, long closing periods. A lot closed December 20, and then it really picked up as deals came on the market. And we touched upon this also, Matt, earlier in the year, that without having the National Multifamily Housing Council meeting that is typically held annually, either in San Diego or Orlando, usually, that's where so many deals are usually rolled out, and it creates a sense of urgency for brokers to buy or to sellers to say, "Hey, get your deal ready to go. I want to launch it at NMHC." That didn't happen this year, and so we saw kind of a slow start to the year, but it's still just ramped up.
Look at
And yeah, so
I mean, look at that. The monthly difference, or the difference between the late 2020 numbers and the previous quarter, it's like more than double.
oh
And
yeah,
and if you bring that over to this year, well, I think we'll easily surpass 30 billion, in
oh yeah.
terms of monthly sales volume. It's yeah, we're headed towards a really incredible end of 2021, I think.
Yeah. Yeah. There's going to be a lot of busy holiday seasons and Christmases getting deals
Yeah.
closed by the end of the year, from brokers, buyers, sellers, attorneys, lenders. It's going to be a busy December. Sales volume by market, you can see, sales are up all over the place. Investment allocation to multifamily, it's been increasing substantially, and this is as a percentage of total U.S. commercial real estate. It was only about 24%. Kind of hovering in that mid 20 range for kind of the since great financial crisis until basically 2017, started getting up to 30 some percent. Now we're almost up to 40%. We kind of said this was going to happen, Matt, last year during the pandemic, early in the pandemic, because, well, really, once we started seeing that, the sky wasn't falling in terms of the multifamily market and things were doing well, we knew that there are going to be more institutions and investors allocating to multifamily. As some investors who had been investing in retail or office or hospitality all of a sudden saw those that the just too risky and looking for safer, better risk return profile, and they're all going into multifamily and industrial, and that's really where this shows up. And but you can see it's not like many things in the pandemic. It was really an acceleration of trends, because the trend had really been going on since the Great Recession, really beyond before the Great Recession. I mean, that's a pretty, that's a trend line right there of consistently going up outside of the actual Great Recession, and then continued to increase every essentially every couple of years. So that I don't think that's going to slow down any time soon, because again, just a fraction, there's so many individuals, wealthy individuals, non-wealthy individuals, regular people who want to invest in multifamily, but many don't even know it's an option to do, and that is going to be more and more well known. Investing in whether it's real estate syndications or real estate funds. Um, I think this is interesting. Not major market to non-major market. Again, the non-major markets are making up uh, high percentage of capital flows and acquisitions, and this because just the prospect in some of those primary markets just aren't as attractive, and we've seen that flow again really for quite some time. Another trend, total return. Sorry, Matt, do you have a?
No, no,
I didn't
no.
want to
That
interrupt you.
I think it is interesting how this flow to non-major markets could really reflect the increased demand throughout. And if people are sticking to major markets because they're worried about, maybe they want an environment where it's easy to buy and sell, where they want high sales volume. Well, if high sales volumes across the board, then there really isn't any reason not to choose a non-major market if the deal works. So
Yeah.
I think that in this high demand environment, part of those barriers are coming down, and maybe we will see investment in less less popular or less
I think so, and I think the result of that is eventually is those markets are going to become more efficient, because reason why we like investing in secondary and tertiary markets, especially in the Midwest, is the inefficiencies. I think the Southeast is becoming much more efficient with all the capital inflows.
yeah.
But so let's just look at well, all right, where are these big investors? What are they targeting? Where's that capital going to be going? And again, just look at all this dry powder, compared to a couple of years ago. But this breaks it down. Opportunistic and value add. That makes up the chunk. With core plus making up, so value add 33%, opportunistic 41.8, core plus 4%, distress 5.4%, debt funds coming in at 8.4, and then actual core is at 6.6. I'm curious, how many, the opportunistic funds, that's are some of those aren't necessarily being described as the risk profile, is just kind of just the strategy of, really just looking for interesting opportunities. When I think of opportunistic, when I think of these subgroups, I think of, risk and return profiles.
Yeah.
Some fund managers don't. Opportunistic is, we're just open to interesting opportunities that may fall in the value add or, core plus bucket. But
I would be interested to see previous years, especially 2019 and 2018, how that pie gets split up, because I
mhm.
wonder how many people are pursuing value add because there isn't new supply coming online. That may, if there were more new apartments, then maybe there would be more core. But again, I'd like to see. It does seem
I,
like people have more of an
I,
appetite for risk.
Yeah, I think the investors allocating to alternative investments, I think they're looking for, they're trying to get out there a little bit more on the risk curve.
Yeah.
And I think that's their value add has always been kind of a sweet spot for many investors.
Yeah.
And core just less so. But also to your point, there's less opportunities for core. Now I think that the opportunistic bucket that probably includes development
Mm.
of core assets. I mean, that oftentimes the opportunity ground up development falls in that opportunistic bucket. So yeah, I think it would be interesting. I'd imagine, and I'm also, this is just a guess, but I think a lot of opportunistic funds were raised last year during the pandemic and probably in 2021 because there was an
Yeah.
anticipation of a lot of distressed assets, a lot of opportunities, and so I heard a lot of people saying, "I'm putting together an opportunistic fund, going to go hunt for deals, and maybe that they're distressed or just for good opportunities." And a lot of those just ended up not happening, and so I'm curious if a lot of those that dry powder, if it's going to if those funds they can't even allocate to other strategies, they're going to have to look for more value add opportunities because everyone's looking for an opportunistic deal, and there ain't that many of them.
Yeah. Yeah.
Um, again, I always like how Newmark does this. They've got the yield spread between 10-year Treasury cap rates. It's relatively, it's definitely increased as interest rates have gone up, cap rates have decreased. I mean, we were really at a low back here in late 2018, but it got pretty attractive in the middle of 2020 when interest rates are so low. Um, we got that average US cap rate at 4.67, although from other sources it's closer to 4.5%. I've seen from other um, outlets. And again, okay, well, here we go. So I guess they have it as 4.5% for major markets. United States at 6.7, non-major markets 4.72. Just some recent, again, attending this market outlook dinner and meeting last night. I mean, there are so much product is trading in the mid to low fours, even mid threes because
Yeah.
of the speculation on rent growth. So I think this is a lagging, a trailing figure, and I think we're going. You know, bet you two cokes that this number is going to continue to decrease. Cap rates by market. Again, I think we're going to see this continue to decrease, but I see 1.5 in Orlando, and this is and that I would imagine is some kind of. Oh, sorry, this is the difference. This is 2020 to 21. You can see this is just exemplifying the type of compression we've seen. So a lot of compression in the Orlando market, but really cap rate compression across the board. I mean, just look at that. I don't see
It is.
nothing's above a 4.
It's still interesting too. These very popular markets like Tampa and even really Orlando and Phoenix, those are on the right side of this graph. Those have higher cap rates than like Chicago, which
And
I don't know.
just from
I'm
I
confused.
I I think that this doesn't necessarily jive with what I've heard out of the Phoenix market of things,
Yeah,
everything trading for cap or below.
yeah.
Let's take it for what it's worth. But I mean, look at San Francisco though. You know, they were sub 4, now they're sub 3.
It seems to be one of the those are that's one of the few markets that's really still in recovery mode for
Hmm.
multifamily.
Yeah, yeah. I'd have to agree, man. Price per unit. These numbers are also different from like compared to we saw the Berkadia report card that we covered last week had average price per unit in the United States at 305,000 per unit. That's closer to where they have the major market average price per unit at 319. But they put the total average for the U.S. Right at 221. Non-major market to 203. Now to me that seems like a more reasonable number and closer to what I'm seeing on just kind of average deals. I mean, we've seen product in the Midwest trade for close to 300K a door, but it's on in very desirable locations, very desirable products. People really paying up, um, but still, that's makes me feel great about Forest Ridge, the deal we've got under contract right now. We'll be closing on here in the next couple weeks. 116K a door versus 221 is the average, so I feel nice about that. Top buyers and sellers, no real surprise here. Blackstone, number one buyer, and then the number two seller. So I don't know if that tells you anything. You're always buying and selling, trading out, but still making allocations. So I think not a big surprise. Okay, and I know this report's long, but there's so much good data that I really wanted to cover it. Effective rent growth, because we've talked a lot about market rent growth, and 20% in many markets. Yeah, I think average, depending on who you're asking, is between 9 and 13% national market rent growth. This is actual effective rent, so what people are actually paying, because you're not renewing people at new market rates typically. Um, Quarterly 5.9, annualized 3.1. So
What?
that
Why is that? Why is that chart going down at the end if it says there's going to be strong levels of rent growth through the end of 2022?
well, it's forecast.
Okay,
I don't know. I think that they have. I think it's probably
a seasonal decrease.
it could be it could be seasonal. It could also just be they have to. What I've seen a lot of forecasts is a desire to like revert to the mean, because it's
Yeah,
like they're like, okay, so let's average it down at the bottom end, like on
that's what I was
CoStar,
wondering.
their
Yeah.
forecasts, they're like they don't know, but they're like, okay, we're just going to assume there's going to be some sort of correction and a deceleration of growth. We don't know, but like we'll just have to bake that in at some point. So
Okay,
that's I don't know that's my
that makes
assumption.
sense.
Effective rent growth by market, and we won't touch on all of these because again, except I do want to the new lease trade outs by market. The average new lease trade out is 17.5%. So getting new leases, and I see, and I can. What's going to start to happen is you're going to see operators starting to raise rents on existing tenants, residents that have been only getting these 3%, maybe 6% increases. Um, maybe, $15, $25, 100, $50. The new leases are going to be so attractive with occupancy being so tight. They're going to say, look, I'm either moving you, you can stay and pay market rent, or you can move out because I've got a list of people who want to
Yeah,
move in here and want to pay 17% more as opposed to 3% more. And
yeah.
a lot of renters are going to be not happy with that. Um, and again, it's the housing crisis. And here we go, talking about supply and demand, why this is the case. Um, with the 271,000 delivered, but we've absorbed 535,000. So, 535 minus 271. I'm not going to
Yeah,
do the math right here, but those people have to go somewhere and they're going to existing properties. And that's what's bumping up occupancy.
almost twice as much.
And yeah. And these numbers are so crazy because, I mean, we're going to see over 300,000 units delivered by the end of the year. But and usually absorption has been outpacing deliveries slightly. And we were basically at parity in 2019.
Yeah.
535,000 that's a big number. And so we're going to see occupancy decrease next year as well, I'd imagine.
Wow.
Supply and demand by the market. You can look at this specifically. They didn't have Indianapolis, so I was curious about that. They included Indy on a handful of these charts, but but
Yeah.
some not. So, I would just be paying attention to where those those differences are. Now, Los Angeles, there's a big difference. I don't know if that's more people can't afford homes, but also I don't want to be building in Los Angeles, but if you're from LA, maybe you get it, you understand. Mortgage debt outstanding. This hasn't really changed, looking at, how people are financing these deals. Although I will imagine in the Q4 capital markets report that they do, you're going to see a shift to much more bridge debt. We've seen many buyers are closing with bridge debt as opposed to fixed rate, permanent financing, because they can't get the loan to value. Because they're running into debt
Mm,
service coverage restraints, and they know the value is going up. They don't want to do a lower leverage deal, and they don't want to lock in their loan amount when they know the value is increasing because rents are increasing so much. And they say, I'll
yeah.
get some shorter term, 1, 2, 3 year, bridge debt, lock in my permanent debt next year or in 2 years when, much of this that we're talking about has happened. values continue to increase a little bit more. Rents are, will have the effective rent will continue to increase. Lock it in at that point. But still, in this report, 50% from the GSEs, that's Fannie Mae, Freddie Mac, all the government sponsored enterprises, banks and thrifts. Again, this is where a lot of this bridge debt is, and that's what I think is going to continue to increase. And I would like to have seen a comparison to, a couple other years in the past,
Yeah.
but oh well. Multifamily mortgage maturities. This is kind of interesting, just kind of seeing how things are trading based on their maturity. It's a little inside baseball. GSE volumes, the GSEs have caps. Their caps were raised this year. Yeah, the lending caps for set at 78 billion for each, and they're haven't hit those caps yet, so they want to lend more. A lot of those are probably going to those, as we've said, a lot of those bridge lenders.
Yeah.
So, Matt, that was a lot of stuff. We threw a lot of stuff at the folks watching, listening to the Gray Report, but I thought it was important
Yeah.
to know where the market is and kind of a little bit of insights into where we're going.
Well, and it all fits the theme, and it is worth reminding. It wasn't just last week where rents were raising. This is going to characterize throughout the end of the year, and it is worth, and at least from my perspective, it's worth a consistent drumbeat because you can get lost in reporting kind of incremental changes and stuff, and that's kind of why a few weeks ago we looked at what people were thinking about in the beginning of the week, in the beginning of the year, and now, and it has changed so much. The character of the market is, there's so much high demand, and there's so much, and it is interesting what you talked about when it came to mortgages and investors kind of speculating on this future growth. And that is really the name of the game right now, is figuring out, okay, what are we going to see in 2021? How's the math going to work, whether it's loans or returns, and seeing how that's going to work in 2022.
Yeah, I think it's, because we're trying to figure out where we're going. But one big issue I've had, or more of a question, is okay, at what point is this rent growth unsustainable? Because you need to see the wage growth, and we hadn't seen a lot of wage growth, especially in the last cycle up until the end, and it hadn't really started kicking off. But we've gotten some more data that really shows that wages are moving. Maybe not as much as rents, but they're moving considerably. And so we've got a couple pieces to touch on that. Matt, do you want to
Yeah, yeah.
start touching on that? Maybe start this.
I
We'll start with the
I'm
capital
gonna
speculator piece.
I'm gonna widen the scope a little bit and say a couple
Yeah.
obvious things. We've heard a lot about inflation, from ourselves. We've covered the Fed, and all of their movements and rhetoric, and now we're seeing more discussion about wage growth here, which I think is a major ingredient in creating this inflationary environment, alongside the supply issues that we've all heard about. But now, bring it back to my point, we're not yet hearing about rent growth outside of the multifamily industry and the multifamily report. It's not necessarily on the headlines like inflation, even as it is this other factor for potential inflation. So we're hearing now about wage growth. We're hearing about the supply issues and the government spending and all of that. And now we're kind of starting to see this outlines of a kind of potential inflation feedback loop with wage growth and rent growth. And it does create a little bit of uncertainty as to where inflation's going and what's going to happen in the future.
Yeah, it's that feedback loop that we've talked about, and that can be concerning from a broader economy. And I think that's the real concern. But in multifamily, I guess, Matt, what are your thoughts on, I guess, the risk of inflation in multifamily? Is it more really risk to the upside, or what are your thoughts?
I still see, and we've reported on this, I still see inflation, at least in the medium term. Multifamily is going to float along inflation. There's still room, I think, for rents to grow and not be as large of a factor in CPI. And that was a part of a report that we talked about a couple weeks ago, how there's still room for rent growth. As crazy as
Mhm.
it sounds, I think the demand is there, and we're going to talk about this in a few minutes. But there's such high demand that it's hard to see any way out of this without rent growth.
Yeah, I agree. So I want to just take a look real quick on this capital speculator piece, if I can figure out how to share it. So, basically, they're comparing wage non U.S. non-farm payrolls during expansions, really since the 1970s. Here we go, and you can just see the slopes and the rate of growth of from the red line is the current index through October. That is a monumental increase of payroll increases. Now, again, you can say we've got a lot of catching up to do, and with this, there's only a handful of these expansions that took place in major inflationary environments, but even then, we've outpaced it significantly. So, and then going back, and then this is industrial production. I mean, we're actually being more, we're producing more earlier in this expansion, and again, this just comes back to this idea of compressing time, compressing a cycle, and
Yeah.
the effects that the pandemic had. And we've really taken at this point 5 years and compressed it, into one, or you can say longer than that. We've compressed it into a year or two, um, and that's something that it throws all of our assumptions and knowledge of history kind of out the window. It's like I was listening to Howard Marks, the managing director of Oak Tree Capital, recently, talking about how this is like a meteor is like crash into the earth. Like there's no, like, our
Yeah.
knowledge of our understanding of market cycles. This is like not it's not a non-economic event that has affected the economy. And then the government intervention that also took place. And this is why last week I think we were talking about, um, or a previous episode. It's That's why it's like this is almost looking like a post-war economy where some anomalous event has just been injected into the system in the reality. But we didn't have, I mean, we have had, widespread loss of life, but it hasn't been like a World War II. We haven't had, in Europe has not been firebombed. We did, nuclear weapons haven't been dropped, fortunately. But a similar amount of, spending occurred. But our workforce was still here. Think about it, the workforce leaving in World War II, but people are still here. Maybe we're working remotely. We've just never experienced anything like this, and I think it's continued growth.
What is a little bit more moderating is their information on U.S. personal income, and it
Hmm.
says that, and I don't understand how personal income could be kind of middling along, whereas the payroll, non-farm payrolls, have just rocketed upwards.
I'm wondering if that's breaking down for people who are working. You're making
Hmm.
more money, but
Okay.
and so, and this is just my ignorance of, like, yeah, how U.S. personal income is. So it's broken down. So if you've gone from a one income household to a two income house,
Yeah.
a two income household to a one income household, maybe that one earner's income has gone up, but breaking it down for per capita, it's
That's a good
it's
point.
gone down. So I think maybe taking the labor participation rate
Hmm.
into account. That's my
Well,
assumption. That's not,
but that is worth mentioning too. All this wage growth, all this production, all this spending that we're seeing so much in, kind of the inflation environment, et cetera. But employment has not yet gotten back to pre-pandemic levels. There are still thousands, millions of jobs that are out there
yeah.
for people to take.
Well, it's fascinating because the unemployment rate has come down so much, but yeah, the actual, workforce participation rate, and I mean, like, millions of people have left the workforce just recently, and so that's just changing the makeup of the economy, um, that's it's going to be interesting, and is that almost again, it's an acceleration of these trends of how much automation are we going to see in a lot of these jobs that just don't come back because we don't need them. But at the same time, we've got whole sectors that need, that we don't have any way to automate some jobs, at
Yeah.
least yet, and we can't fill those roles. And every time I go down the street, it seems like somebody's hourly rate has gone up from $1 or 2. I mean, you've all seen the signs.
Yeah, but
Now
then they
hiring.
also say they also say flexibility, ultimate flexibility required. And so people say, well,
Well,
can't be
what does
that
that mean?
flexible. They're not ready to be flexible.
No, they're not. They're not. Okay, so this is just piggybacking. This is more of a multifamily perspective, from Real Page. This is a Greg Willett piece, right? Apartment renters' incomes climb sharply. Basically breaking it down, residents of so this is specifically renters of apartment communities. Their incomes they earn 8.4% more than new move-in renters did in 2019. That's sort of in line with rent growth, market rent growth in
Yeah.
many markets. In many markets, it's double that though. Um, but that's is relatively good to see. And but on the flip side, the other, other edge of the sword is, it leads to that feedback loop that you were talking about, Matt, of
Yeah.
wages and rent growth, because then apartment operators are saying, okay, your rent income level, you got some room there.
You can afford it.
Well, you can afford more. What can you afford? Because, on new leases, you're looking at their income statements and, okay, you've got people who are earning a lot of money. Well, okay, maybe they'll pay a little bit more. We'll see.
Yeah.
Yeah.
And
And
well, and I
again,
think
yeah, so go ahead, Matt.
you look at another from another perspective, it's housing prices as well. There we've talked a lot about lifestyle, and I think that there is a kind of cultural element. Last week we talked about Gen Z and millennials and how they're differing attitudes towards homeownership, but I think ultimately it is what can you afford.
Hmm.
And yeah, that's kind of what's guiding a lot of people's decision. And as wages growth, as wage the income of renters grow, the reason why they may not be buying a house is because maybe house prices have risen even more.
Yeah. Well,
So
100%. And I mean, we're going to get to this in just a second, but I mean, we're looking at that, Case Shiller Index, and in a couple articles of, what only 83% of single family rental residents could even afford a mortgage if they wanted to buy a house.
yeah,
So it's not even necessarily more people are in that renters by necessity category, even though they may be making a good income, very solid income, but I don't have the down payment, or you just can't afford um, that mortgage. Matt, just really before we get into more of that single family home stuff, I thought it was important to cover Real Pages top 10 takeaways from apartment REITs Q3 earnings calls. Parsons put this report out just a couple days ago, and I just want to cover it shortly because I think it's important to watch what these big REIT operators, they've got huge portfolios, a lot of insights, and they've got really the resources to be on the leading edge of new operating practices. REITs are serious about reducing on-site staff. Makes a lot of sense. 24/7 tours, virtual self-guided tours, fully online leasing to resident portals, fully online leasing, and people to sign up. That's not new. And these virtual self-guided tours, that's picking up steam. Really started picking up steam in the pandemic. But again, if you have the ability to reduce your on-site staff by one person, um, or make that person a part-time employee or a swing employee at multiple sites, that can really be a strong increase to net operating income. And next piece, renter income are soaring. We just talked about that.
yeah,
Again, it's in this MAAs. Um, Tim Marcos said if we go back to Q3 of 19, 2 years ago, income for our residents has gone up 17%. So while rents have increased quite a bit, our incomes have as well. So I think that's interesting. There's a huge upside in renewal pricing in 2022. This is something we've just covered repeatedly, just the difference between market rents and renewals. They're still saying it's a great time to build and buy apartments. We would agree with that. Supply chain issues are real, but not debilitating. And I would echo that it's frustrating, but you can figure it out. Coastal cities are rebounding, but regulatory issues are problematic. Yeah, we'd much rather be in landlord business friendly states than a lot of the coast. Diversification is the name of the game. Be economic or geographically diverse. Have some good sponsors. This isn't what they're talking about. They're talking more about geographic diversity, but something that
yeah.
we talk about all the time
That's
is
what we just said. Yeah,
be having a diversified portfolio. Is a great way to reduce risk. Lots of concern about rising property taxes. Yep, that's a big factor in where we invest. Smart home conversions are big. Definitely true. This is something that I think is going to just continue to grow, but I think it's a question of like how much renters care, how much rent increase can you get from a smart home package, or just is it more of like you're going to increase retention?
Yeah.
And then, final takeaway: inflation is not a major concern. Um, and Matt, I'm curious in your take. I'm almost thinking that it's not that a concern that they think that it's not happening or we're not going to see elevated levels of inflation. I just, I it seems like it may just be more that maybe a tailwind for
Yeah.
multifamily industry than anything. So we're like,
Uh,
yeah,
yeah. I think that
concern, but
well, at least this is my take, and however clumsily I tried to word it before when you asked me, was that yeah, inflation will help the real estate industry. There's room for rents to grow without kind of sending off alarm bells in inflation, or at least there's kind of there's going to be a little bit of a catch up when it comes to rents being a factor in inflation. And also, as long as multifamily floats above inflation or kind of tracks it, then you really worry about just the broader economic consequences. If inflation causes an economic downturn, then that's a problem. But
yeah.
I think that the fact that they're uh, not worried about inflation means hopefully there's not going to be a downturn. Multifamily is going to float above it. That's not that there won't be one. Not that prices won't
hmm
rise.
Yeah, I think that's the right take of in for just elevated levels of inflation. It's definitely a positive attribute for multifamily, but it gets to some point in the whole economy. It brings the economy down if the Fed
Yeah.
increases interest rates, and that's not good for anybody. So, all right, Matt, I want to just move on to single family rentals. And I don't want to spend, an infinite amount of time just
Yeah.
because we're already, this is a longer episode, but I think it's packed full of good information. So I think it's important to touch on it. Um, give us your breakdown. What's going on in this
Yes.
single family?
There were
You want to talk about single family rentals in general? You want to talk about build to rent? Where do you want to go with this, Matt?
Just both of those kind of more about really they talked about diversification in the last one as different markets, but I'm seeing all these articles that propped up this week about it seems like there's a lot of demand from investors into residential housing, and whether they are kind of squeezing into other markets, whether they're kind of going into other forms of residential real estate like build to rent or single family rentals. That's another thing too. But I still would characterize this part, which is single family rentals, that part of the housing market, not necessarily as a threat to multifamily, but really as a place where housing demand is going. Demand, like I said, from renters and investors. We spoke last week about changing home preferences from millennials and Gen Z, and home buying age could be home renting age for a lot of millennials who are starting a family and want more space. I know that it may be jumping ahead a little bit, but there's a profile of single family rentals that the Amherst Group did, and the upshot of it basically is it's not necessarily and you mentioned this before. It's not necessarily that people are choosing to rent and they could buy. It is really that renters don't qualify for mortgages and either do not have the credit history or income balance to get one. This is very telling, I think, and it really does underscore the need for rental housing in an environment where home prices have skyrocketed. Like I said before, wages are going up, but house prices are going up too. And the real bedrock barrier to these people that want to live in a home, maybe want to buy one, the real barrier is they just can't qualify for that loan. So it's
hmm
not necessarily preference as much as just they want a home in a spot and they can afford to rent more than they can afford to buy.
Yeah, I mean, I think it exactly. It's not really a choice at some point. Some people, unfortunately, do have that choice, but it's just not an option for a lot of individuals. I mean, and it's not a surprise that single family renters have lower incomes than owners. But it explains why you're not people. There's a demand to live in a single family home, having your own spot, your own yard, maybe your own garage, all that stuff. But to buy it, to come up with what's the average down payment, today, so what's $75,000. That's a lot of cash to like
Yeah.
to just have, even if you're borrowing, and that's for the lower end. That's for like, I mean, kind of like your starter homes that are hard to find. I mean, if you're buying what they're building today, which are like, homes in the 500s and up, I mean, so, That's over $100,000, dollars for a down payment. That's a lot of money for
Yeah.
a millennial to have in cash. So that's fascinating. And then again, we I think we already mentioned this today, but just looking at the Case Shiller Index, it is no surprise, especially to those of you who have been following us here at the Gray Report. But single family homes, the prices have been accelerating and accelerating and accelerating. That slope is just, again, the rate of
Yeah.
the change there. It's fascinating. And then we don't have, I mean, I don't think we have time to really get into the really all the meat and potatoes of this build to rent special report by Northmark. But I wanted to highlight it because it's something that we've taken an increased interest in. Is this preference from, like we're talking about, millennials want to live in a single family home, but they don't want to buy it. They don't have that down payment. You want to have a backyard for your kids, your dog, or whatever. Um, this build to rent where basically you're buying a subdivision or you're building a subdivision of single family homes and you're going to rent them out and you're going to basically operate the neighborhood like you would an apartment community. If you've got a
Yeah.
clubhouse, you've got a leasing specialist, you got a property manager, you got maintenance, you've also got amenities, you've got the pool, you've got the club, quality fitness center with spinning bikes and all of that. You've got shared office, all kinds of great amenities that you wouldn't get. You could go out buy a house, but
Hmm.
you're going to buy that you're not going to be able to afford. You're not getting a pool. You're not getting all this other stuff. You're going to have to get a gym membership or build a gym, which your house at that price range isn't going to have. So I think it's a very interesting
Yeah. Page
thesis.
that page 15 shows a lot of, you can see kind of the different designs of some of these neighborhoods and some of these communities, and they're all a little bit different. And it's what's interesting, and what I would kind of think about as a homeowner is are these all cookie cutter houses? What are you buying when you're, or what are you renting when you're renting a home? Because I have been a single family rental before, and you do take a little bit of pride of ownership, and you want to live somewhere that looks nice in a nice neighborhood. And so it's very encouraging to see this, the variety of designs here. And it looks like as this sector expands, we're going to see some more creativity here.
Yep. Yeah. I think so too, because is it going to be? I don't know if it has to be all or nothing. Does it have to be all just homes? Can it be? You've got
Yeah,
some townhomes, you've got some duplexes, you've got some flats, and then you have single family homes or cottages. Um, I think there's a lot of different options because I know the some assets we've either looked at or we own that have either have direct access, the direct access, having your own door. There's no common hallway. Those are very attractive. If you've got a garage, especially in an attached direct access apartment with direct access garage, that is very much in favor. We're seeing some groups add these, really kind of private yards, even to, like a flat on
yeah.
a first floor unit. Um, so I think this is definitely where I think a lot of this is going, and it's I think very much in the early stages.
And I
Talking
think,
about yeah,
as well, and we've mentioned all of the kind of financial considerations and the generational, but also the rise in, people want more space too.
oh yeah,
You can go outside, you get more real, you get a yard, like you just mentioned, and you get more square footage. And I think that that's a real big benefit that's really increased in the past year and a half because of COVID.
well, and you think about the single family home the builders who are doing a lot of this. It's easier for them because you can get away with more cookie cutter designs
Mm-hmm.
because you don't have because people they don't own it. They want it to be a
Yeah,
nice
yeah,
place, but you don't own it, and so it's not like I need to have a special. I want my den to be here in the house, or I need to
yeah,
pick
yeah, yeah,
out all the trim. A single family developer can come in, same finishes, same everything, knock it out. Like some of the efficiencies in multifamily, you're just knocking it out. You can do it cookie cutter, but if your cutter, the end product is attractive, I
yeah.
think it's
That's true.
okay. I think it's
That's
okay.
yeah, I agree. Yeah, you're right there.
But it'll be interesting. And then and then we showed this a minute ago, but this, I think, because single family homes are so unaffordable, that is why um, investors have made up 18% of all homes purchased in Q3 of this year.
And I also want to note this too, and we talked about this way earlier this year, because there was like, oh, is the investor out next door? Is your neighbor is your neighbor going to sell the house to the investor? Who's buying all these houses? And there's almost like a threatening tone to some of the articles that are outside of the kind of investment periodicals that we read. But I don't think that home buyers need to really be scared of investors. If home buyers are bringing their own laundry list of things that make it incredibly and make them incredibly interested in buying a home, this is more of a uh, result of demand than anything else.
Yeah.
I don't think that this is investors horning in on home buyers and trying to kind of reshape the way that humans live in America. But that's just my own take.
Yeah, no, I agree. I think people just get frustrated and they see that as the reason that prices are being driven up as opposed to just demand for housing in
Yeah,
general. And whether it's a flipper or someone who's turning it into a single family rental. Well, there's a lot of demand for single family rentals as we've seen. So that people are demanding that. Residents are demanding that. They want to live in the house. They maybe don't want to own it or can't own it. But then also, a lot of single family home buyers, they don't want to renovate a house. They want to buy it, basically turnkey, ready to go. And so you can get mad at flippers all day long, but the reason why flippers do what they do is because residents don't want to do that work themselves, and so they
yeah,
take something that is, been and has a lot of deferred maintenance and issues, and needs to be made, more modern and bring it up to spec. Now, a lot of bad flippers out there that do bad work. I think that's an entirely different, criticism than they are changing the market itself.
yeah,
So, um, Matt, there's one place on the internet where you can find similar level of great information on the multifamily industry. It's called grayreport.com, and it's the premier multifamily intelligence aggregator. It's bringing in all different research reports, articles, insights, as well as videos, podcasts, and more, all related to the multifamily industry, real estate, and the economy. This is another product of Gray Capital and the Gray Report, but it's updated every single day. So if you want to hop over, you like this stuff, you want to stay up to date, you can't wait a week for the next video or the next newsletter. We get that. You can hop on over to grayreport.com. But if you're not getting the Gray Report newsletter, you can just hop on. You can find the link at grayreport.com or just go to graycapitalllc.com/newsletter. That's graycapitalllc.com/newsletter. Quick form. Just give us your email address. That's all we need. And you're going to get the Gray Report newsletter. And we say this all the time. And just because I think that, Matt does a great job putting the newsletter together, a lot of work goes into it. It's the best. It's the best damn multifamily newsletter out there. I'd say that for sure. And we're hearing it from a lot of other very sophisticated investors who are like, keep these reports coming. There's no fluff. There's no fluff in these newsletters. It's not, they're not marketing emails to pitch you whatever. You may, for once in a while get, hey, we've got a new deal, but it's just solid, good, just it's information. So grayreport.com or graycapitalllc.com/newsletter. Any closing thoughts, Matt?
I got nothing.
Okay.
Hey, don't forget to brine your turkeys before Thanksgiving.
So, but
It
there's a
comes up.
debate. There's a debate about brining or not brining.
I'm on the brine side.
I am too. I don't think it hurts. The little moisture, little moisture isn't going to hurt anything.
Takes
Um,
time.
but so now, are you? Do you like the traditional? Just pop it in the oven, deep fry, smoke, or
I will.
do you leave the turkey cooking to somebody else? Throw-
Usually I leave, but if I had to choose, deep fried all
yeah,
the way.
yeah. So what I haven't tried, I've done deep fried. I like smoking the turkeys. I
Yeah.
put on the big green egg. I think you gets a really nice smoke flavor. I do a little bit lower and slower than just like a grilling. So I usually cruising at like 175, 200. A little bit takes a little bit longer, but great flavor. What I want to try though, and I haven't and I not no plans, but maybe I should make plans to do it this year. Smoke it probably like 90% of the way, or maybe all the way, and then finish it off in the fryer.
I like where you're going with that. I'm gonna bring that to my I'm
But
gonna
it's
bring
like,
that to my smoking guy.
yeah, yeah. Oh, yeah, we should talk to Gomez about,
Yeah,
because if you had like chicken wings that have been smoked and fried, they are delicious.
it's
It's a
only
great
additive.
combination. Yeah, it's only better. It's like, why only have one? Why can't we have our cake and eat it too? So I think the
Right.
smoking the turkey, then deep frying, I think that needs to be tried. If you've done this in the past, let us know in the comments. Um, also, thoughts on the video in the multifamily industry, but tell us your turkey thoughts. Well, I guess, yeah, happy Thanksgiving, everybody, because next week is Thanksgiving. There won't be an episode. Matt and I are going to have to figure out how we're going to record. Well, we got the internet. It's great. We're gonna figure it out. We'll have to schedule things. But the next time you see a report, not going to see my office it's blurred out in the back. You may see some boxes back here that are blurred out. Um, but you're not going to see Matt's awesome view of the War Memorial. But we've got the new office is really cool. Way cool. We've got a great setup. It's going to be awesome. If you're still watching this video, you have to give this video a like, because you've watched the whole thing. You got to do. You can't not like this video at this point. You've made the investment, and if you're not subscribed, hit the subscribe button. Leave a comment saying I watched the whole video, I liked it, or you guys talking about turkeys. Not what I'm interested in. I think we gotta have a little turkey talk.
Oh yeah, yeah, yeah.
Okay,
It's good.
good. It's good. See everybody next week on the Gray Report. Have a great rest of your week and make some good investing decisions while you're at it.